Okay, there we go. Rock and roll.
Okay, rock and roll. Good
Oh.
evening, everyone. Thank you so much for joining us tonight. I hope you have all had your dinner. It's been a good week and day for you so far. We're very excited today as it's the first of our RBC Investor Class Series. The purpose of us starting the Investor Series is to really build a community where clients can have access to correct information, where they can actually make better investment decisions. We will have 3 speakers today, and this webinar will be divided into 3 sections. At the end of the webinar, we will also answer some questions. So if you have any along the way, just feel free to type them in and send it to us in the chat. I'm Jess, and unfortunately, the oldest among all the 3 speakers here with over 20 years of experience. Thank God, huh? I have been involved in the real estate industry in various capacities, from research, compulsory acquisition, market studies, and finally project marketing in 2006. I have to say I have been extremely blessed in my career. And after I pioneered bringing UK projects into Malaysia in 2009, the market response has been overwhelming. Shelvin has been my colleague for the past 15 years in Henry Butcher and also JLL Malaysia, and she's now my business partner and fellow co-founder at RBC. She was from Melbourne University and knows Melbourne at the back of her hand. So if anyone wants to invest in Melbourne, you can call her. Shelvin is, of course, also very well versed with the UK market, having marketed over 300 projects together with me. And finally, the third speaker for tonight is our colleague Nazim, again, our ex-colleague. He is the youngest amongst us, but has still chalked up an impressive 10 years of experience in UK, Japan, and Australia properties. Clients love Nazim because he's very analytical, and he's been dealing with not just high net worth investors, but also institutional clients. So thank you again for joining us tonight, and I will now start the first section of the webinar. Now, as investors ourselves, we believe that many of us share a similar end goal. So for me and my family, we have adopted a heavy lean on real estate all these years because we did not want to take too much risk with our hard-earned money. And the reality is also because we don't have enough spare cash to lose in speculative investments. So here's a diagram showing an investment portfolio which many of my peers and also clients share. Now, there are 2 baskets here. One is a safe basket and the other one is a speculative basket. In the safe basket, a lot of us are about 80% to 85% invested in real estate, blue chip stocks, and also dividend yielding stocks. And from that basket, the goal is to generate an income sufficient for my kids' education fund and my retirement next. In the speculative basket, I'm basically punting. I don't know if I will win some, win big, or lose it all. This can be your cryptocurrency, your startups, your speculative stocks. Now, I treat this output from this speculative basket as a bonus income. If it happens, I'm going to treat my family to a nice holiday or get expensive present like the car I always dream of, or a nice piece of jewelry. Of course, everyone's weightage and preference in their investment portfolio will be a bit different, but this also changes as we reach different stages in our life. But in essence, I believe that many of you who are listening in today, you believe in investing in the safe basket. So now I'm going to share what has worked for me and a lot of my clients and tell you why investing in the UK makes sense. And we have summarized them into 4 reasons. The first reason is that UK is an established economy, which offers a lot of certainty to investors. Now, we know that investing in real estate requires a larger amount of capital, especially if you're doing it without a mortgage. Some people don't like to borrow money. It's different from buying stocks or bonds where you'll be able to buy them in smaller quantity and lower capital. So it's very logical for many investors to want to play safe when it comes to choosing their overseas property investment market. Looking towards an advanced economy makes a lot of sense to me. UK being the 5th largest economy in the world and an English-speaking country where we used to be their colony as well, offers a peace of mind. It's democratic and it has a transparent legal system as well as a strong currency, which adds further assurance to me as an investor. Now, I know that COVID news have now almost disappeared from the daily news channel, replaced by other headlines now. But UK is one of the first world country who has actually achieved a high vaccination rate and reopened its door to the world despite going through severe COVID restrictions and infections. I'm currently based in Brisbane, Australia. We celebrate Queen Elizabeth's birthday here, different day, but we still celebrate. And it's common knowledge that Australia tend to follow the UK model in many areas. Australia tend to let the UK test it out. Then if nothing bad happens, adopt it, which is what has happened with our COVID vaccination. And Australia is really not the only country that look towards the UK for leadership in many economic, research, and social issues. The unemployment in the UK is also very low. The figure here says 4.1, but it's actually 3.9% now, which is really impressive despite the GFC, Brexit, and the pandemic. The second main reason is the high population growth in the UK. How a country's population growth is faring is an important piece of information for property investors, and it has a direct impact. We want to understand if the population is growing, at what rate, where the growth is coming from, as it all ties back to the demand for housing. The current population of the UK is approximately 68.5 million, which has been increasing at around 0.53% year on year, which is the latest data that we got in 2020. I just want to put things in context here so we can understand this point a little bit better. So I'm going to compare this yearly change to the most populous country in the world, which is China. Their yearly change year on year from the same 2020 data is 0.39%, which is lower than the UK population growth rate. Now let's examine this population growth a bit deeper. More than half of the increase of this UK population between 1991 and 2018 was due to the direct contribution of net migration. Net migration is the balance between people coming in and people going out, measured over a 12-month period. So in this chart, you can see that there is a forecast of a low net migration and a high net migration, which takes us from its current estimated of 68.5 million to a 70 to 75 million population growth by 2043. And you will be also interested to know that the median age for these migrants are actually about 40 years old, indicating a healthy population who will continue to contribute to the economy and require housing changes as they reach different stages in their lives. I'm going to also show you quickly how Malaysia is doing with its population growth. So our current population stands at 33 million, and our growth rate is actually higher than the UK at 1.3%. If you look at the table at the bottom, that's the inflow and outflow, where you can see that the majority of the inflow of migrants are from all these countries listed are predominantly engaged in domestic work, construction work, which has helped many Malaysians here in our everyday life. But unfortunately, I don't think they are going to be the tenants for your investment property in Malaysia. And at the same time, you will also notice that we have a high outflow of Malaysians to more advanced economies such as Singapore, Australia, the US, and the UK. Something to ponder upon if you're a Malaysian property investor. Moving into the third main reason is the housing supply shortage in the UK. Now, the third main reason is very much economics 101. As investors, we try to spot the market where demand is always greater than supply, which obviously drive the prices to go up. It is also because of this housing shortage that drive rental growth throughout the country, with London taking the lead at 5% in Q3 of 2021. Now, you may ask, why couldn't the UK produce more properties? Well, I'm sure they would love to, but they are met with several supply chain barriers and challenges such as high land prices, which again is driven by high demand from developers who want to build housing but are priced out of the market due to the intense competition. And in the capital city of London itself, the demand to acquire land is not only restricted to local UK developers, but very much sought after by international developers, even the ones from Singapore, from Malaysia. So we have EcoWorld, we have SP Setia, we have IJM, and then you have Hong Kong developers, Middle East developers, etc., leading to a very fierce competition on the ground. The second point that we have is the scarcity of land, especially in London, where it's really landlocked. And the third point is that it has a lengthy planning permission process, which as a developer, you not only need to have the right planning team, but you also have to have deep pockets to fund this through. UK is also a very democratic country where public consultation is important, and any objection from the public will delay the approval process. I actually did planning law during my studies, and I can tell you that the planning application, especially for big projects, really takes years to be materializing. Next, the target for the UK government is to supply 300,000 new homes per year. But due to all the barriers which we have touched on in the last slide, this target was never reached. With the disruption caused by the pandemic, it has further set the delivery back. Of course, now the pressure has eased a bit with the reopening of the economy, but our research shows that there is still an approximate 84,000 housing shortage in the UK, which is a massive issue for the UK government to tackle. But for investors, it means that our investment will continue to appreciate positively. As the epicenter of housing crisis, London has been very successful in creating lots of jobs and opportunity in the last decades, but unfortunately failed to provide and build the homes that these people need. There is still a housing shortage gap of about 12,300 per year, which this demand then led to a very strong rental market in London. We spoke to our clients and our London partners on the ground just last week, and properties are getting rented out in no time, mostly under 2 weeks, many within days, and some in hours. And that's what all investors want, a secure rental market. I'm going to jump back quickly again into our homeland, Malaysia, to take a look at our housing situation. You can see that, unfortunately, we have quite an overhang situation here, which can imply that we are simply not supplying the right kind of products our market is demanding. And with supply being more than demand, it is no wonder that there has been downward pressure on our property prices and rental. The fourth reason is the low vacancy rate, or if you're not familiar with that term, high occupancy rate in the UK. So that as investor landlords, you will consistently receive a steady income from your investment. As we have established earlier, the fairly resilient levels of demand, even throughout the Brexit and the pandemic, has translated into low vacancy rates across properties in the UK. Our letting partners on the ground have feedback that office tenants have started returning in the last few months, seeing rental prices going above £2,000 a month. And these tenants are highly motivated. They have stable jobs and do not want to spend hours commuting daily. And these are some of the projects that we have been completing in various phases throughout the regeneration program. And in recent times, we have managed to achieve 100% occupancy rate. Even through the pandemic, the maximum letting time that we had was 4 weeks. But right now, those that are completing in the last 6-7 months, we are talking about under 2 weeks, many within a week. So in Malaysia, we don't have a published vacancy rate. I personally think that it will be so helpful if we do. So we can only gauge from completion being done to know that newly completed buildings in the last 3 years have suffered from the decrease in rental demand due to the MCO restriction, the closure of our international borders, and the temporary suspension of our MM2H program. Also, many investors do not realize that Malaysia actually has a very small rental market. So the sub 500,000 property are doing better in finding tenants in a shorter time, but the higher value property segment are generally struggling with falling rental yields and taking a long time to find tenants. Finally, some of you may be wondering what is a healthy vacancy rate. And generally, we say that a vacancy rate of below 7 is considered healthy. Now, apart from the 4 main reasons, there are also many other reasons why investing in the UK market makes sense. But predominantly, we should determine that the UK does offer strong fundamentals which offer solid support for the continuous growth in the housing market. And with that, I conclude the first section of the webinar. I hope you guys haven't fallen asleep, huh? Okay, moving into the second section of the webinar, we will now go into how you can actually make money from investing in the UK property under current climate. I know we have already some questions about the Russian-Ukraine conflict on property prices, which please stay to the end. We will address that in our FAQ section. So in the world full of economic uncertainties now, investors feel more comfortable if they can invest in a more dependable city such as London when we are talking about real estate, okay? I saw this happening in 2008 during the global financial crisis. That was a very grim period. Recession was looming all over our heads. I will remember walking along the streets in London in 2008, November, and it was like a ghost town and everybody's, was really downcast and all that. But the savvy, opportunistic investor from around the world woke up. And very quickly, they started moving their money into the London property market. And the London property market actually rebounded very quickly from there. We will now examine why London is so special in the next few slides. Now, London position as the center of the world makes it an ideal destination for international companies looking to do business with markets around the world. London has a multicultural population and is highly skilled. So there are about over 250 languages being spoken in London. I personally can only speak 2 languages and 3 dialects. So 250 sounds like an incredible number of languages, being spoken. And it may be also good that you know that about a third of the UK graduates actually moved to London upon completing their degrees. So it's actually not surprising that about 24% of those living in inner London are aged between 25 years old to 34 years old. Over half of the workforce in London are actually educated up to at least degree level. London is also a competitive location for business. It has lots of advantages from the legal, political, and regulatory frameworks that suit a lot of global companies. London has the highest number of new businesses being registered. When we're talking about 2021, there is actually approximately 220,000 new businesses being registered in London. I'm going to let that sink in. If you work that backwards, that's about 80 new businesses being registered per hour. So from a business perspective, it's fantastic because you have actually a ready pool of suppliers and partners that you can network and grow your business from. Fourth, London's geographical positioning is fantastic. It sits next to mainland Europe. It's between America and Asia. So the time zone actually overlaps. So it means that you can reach most financial hubs such as New York, Frankfurt, Singapore, and Hong Kong from London in less than a day. And finally, London is also a great city for entertaining visiting clients. You will never run out of places to take them, from world-class museums to Michelin-star restaurants. To many high net worth individuals, owning a property in London is a must within their investment portfolio. And in the last decade, we have seen a new breed of Southeast Asia money pouring into the London market, which we know many of our clients actually tell us, thank you, for realizing my dream for me, making London property part of my family portfolio. So I think that's something that is quite special and proud of as well. And when we discuss how successful London is and the UK is with the global branding, you cannot not include the royal family. Never in history has there been so many films, books being made and written about any royal family, which goes to show how far-fetched the global appeal for UK is. We move into the second pillar now as to what makes London the most resilient and dependable city in the world. And that is its ability to constantly reinvent itself. London is a very old city, but it is also the most sought after global city in the world for business. Hence, the success of London's economy is key to driving growth for the rest of the country. So post-Brexit, London has been lobbying for new business sectors. The tech hub is hugely successful. The bioscience and the med city is developing very strongly. There is also the lobby for international students to stay on and find work post-graduation. And of course, it's actively replacing the loss of income from Brexit with increased trade relations with other key markets such as Japan, Australia, China, North America, India, and etc. Now, there are recent examples of international firms making London their HQ, including recently Shell, who's just announced that they are moving their HQ from Netherlands to the UK. With the current Russia and Ukraine war, we know that investors are more cautious. They're more pessimistic towards investing in Russia, Ukraine, in related industries. Companies who have decided to close their operations there now may choose to close for good and move to less risky countries such as the UK, where London, as the economic powerhouse, could stand to potentially benefit from this relocation as well. Foreign investment is a key driver for jobs and growth for the London economy. So HSBC has been talking about relocating its HQ to Hong Kong several times throughout the years. But recently, they have recommitted to maintaining London as their global HQ. And joining the many MNC firms includes Google, who has just made their second $1 billion purchase of another office building in central London to house together 10,000 employees in 2 buildings. That's a very big vote to London as the world leading tech hub. So today, London is not only known as a financial service hub, okay? It's not known just for that. Its reputation has, as a Europe, Silicon Valley is getting increasingly known. In fact, London is now established itself as a fintech, where in America, you have the Silicon Valley in California, then you have the Wall Street in New York. But in London, you have the best of both worlds, which makes the city even more compelling for many businesses to be there and the city so investable. And of course, with that, attracts a lot of attention from the venture capital. It has been flowing into the city with some $12 billion. It's raised to be deployed in London, and the tech sector has definitely been the dominating sector in achieving that. The third reason why London is the most reliant and dependable city in the world is the amount of infrastructure spending London has been investing. And we will go into more details in the next few slides. London has a huge infrastructure investment needs. The capital city's transport system is the most congested in the UK, and it struggles to meet increasing demand. So similar to our KL structure plan, there is a London plan as well. It basically maps out the investment required to upgrade the transportation system, affordable housing needs, and etc. by 2041. So approximately, this is a 20-year plan. This total capital expenditure requirement is expected to be in the region about 970 billion from now until 2041. So the scale of the investment required is substantial, and it has a deep economic links between the capital and the rest of the UK, meaning that the benefits will extend far beyond the London boundaries. Now, the London plan breaks down with transport being given the highest allocation and housing in second place. That's important for investors to know, because we know that with every infrastructure improvement made to an area, there's a direct correlation on the growth, whether it is in terms of the rental as well as the capital values. This is an example of a major infrastructure project being carried out to improve the public transportation in London, halving the time of the journey time from west to the east of London. It's known as the Elizabeth Line, and it is the most significant addition to London transport network in a generation. So the new railway will transform life and travel in London and the Southeast, reduce journey time, create additional capacity, and transform accessibility, and obviously provide a huge economic boost. As you can imagine, this will have an immediate impact on property prices around any cross rail station. So prices typically have gone up by at least 30%, and we expect to see rental demand and value growth once the Elizabeth Line starts running in a month or two time. I hope I have managed to convey the message across on the impact of infrastructure spending on property prices. And in a city like London, where everyone uses the public transportation, whether you're a member of a parliament or a CEO or a student. So from an investor point of view, it will be very helpful if you understand the kind of infrastructure spending that will be in the area that you're interested in. What is the proximity to the new station? Because that's going to have a positive impact on your rental demand, growth, as well as your appreciation. You can see in the picture here, there's another new railway connection which has been announced. It's called the HS2 or the high-speed rail. Phase 1 of this HS2 will see two new stations in London being built. That's in Old Oak Common, and the other one is in Houston. And they're expected to complete between 2029 to 2033. So you can speak to us afterwards about properties that are near these stations as well. The fourth pillar is the strength of London as an education hub, which has driven many parents globally to rent and buy properties for their children. This is very familiar grounds to many of you, so I won't go into too much details. But did you know that as a world-class education hub, that higher education in London contributes close to 8 billion to the economy and employs approximately 100,000 staff directly. That's a lot of housing that needs to be provided as well. You may also be interested to know that London produces more than 130,000 graduates every year, of which 70% remain in the capital to work. And again, that translates to a very stable rental market where many were eventually geared towards buying their first home there. And the final reason to complete why London is such a dependable city to invest is the attractiveness for business and holiday travelers, all of which have a direct impact on its housing market as well. The Heathrow Airport in London is the UK's largest and busiest airport, as well as being the busiest airport in Europe itself. As the world's third most visited city in the world, pre-COVID days, of course, the tourism industry in London generates over 100 billion per year, contributing approximately 12% to the London economy. Obviously, this segment of the market has dipped significantly during these last 2 years, but we expect to see the return of more business and holiday travelers to strengthen as borders around the world are easing. All of this again means the return of more workers from the hospitality sector back into the city as the industry recovers and occupancy rate will look to strengthen as well. We have now examined in detail as to why London is the most reliable and dependable city in the world. All of the factors which, despite all the uncertainties that the world is facing now, still puts London in a very favorable investable position, because the unemployment rate is below 4%, which leads to a very stable income outlook. So even with the rising interest rate hikes of approximately maybe 1%, we'll reach 1% by June this year, that's the forecast, it will not drastically impact the housing market as there's simply too much demand and too little stock. Now, the second lesson or point for investors that you should invest into a high volume marketplace. London offers a big enough marketplace where active property trading takes place daily. If you look at this chart, transactions of the lowest value, which is the green bars, have diminished through time. It has reached the height of transactions in 2007, just before the GFC. Transaction values, since the GFC, the transaction volumes have dipped, but the transaction values have increased, with more expensive properties being bought. So the red bar is the expensive over £1 million, okay? So with all this green news in the last 2 years, you will naturally assume that property prices, interest, transactions to dip significantly, but it did not. In fact, 2021 was an extraordinary year where over 87,000 transactions still took place, and that's properties. You will also notice that the properties in that red bar, which is over £1 million, did not decrease in volume. So what does this high transaction volume translate for you as investors? Well, buying property is an illiquid natured asset in comparison to stock. Even when you buy stock, you want to buy in the larger, more active marketplace, such as the US, Hong Kong, Tokyo market, as they tend to be more buyers and more sellers, translating naturally into price movements, which makes it more exciting. Same goes for finding the right marketplace to buy your property. We are all just investors at the end of the day. Even if I know some people tell me they are buying for their own stay. But maybe one day they will still want to upgrade, they want to sell. You must think of your exit strategy. Definitely, it makes more sense for investors to put an illiquid natured asset into a liquid marketplace. So that asset becomes a liquid asset. Now, the total population London is approximately 9.4 million. The second biggest city after London is Birmingham, which stands around 1.1 million. And every other city in the UK after that is much smaller lah. So to me, the bigger the marketplace, the more buyers and sellers there are, the more chances of that price movement, which is very important when you want to exit from that market itself. And now for the third and final lesson or point, I will pass the speaking time to my colleague, Nazim. Thank you.
Thank you very much, Jasmine. So first of all, I give everyone some time to take a breath. There's a lot of information to take on. So yes, thank you so much, Jasmine, for that comprehensive talk on the most reliant and dependable city in the world. I think it is safe to say that even if the talk stops here, I'm already enticed to invest in London. However, in risk management, we always want to increase the odds in our favor. And to increase these odds, I go to the next point, which is invest in regeneration programs. You can think of it in the Malaysian context of locations such as KL Central or Desa Park City, because these areas previously had outgrown its use and it had to be redeveloped into a better planned township. And why invest into regeneration programs, you might ask? Okay. A couple of things happens when an area undergoes regeneration. Well, first of all, you would have demographic changes as the area attracts more and more groups of people from various backgrounds, most of whom are coming with a higher income. Secondly, there will be new infrastructure spending from all stakeholders, such as government bodies, developers, and investors in order to bring up the area into a better township altogether. And thirdly, the area would have an entirely new landscape with better planning in terms of lush greeneries, more organized traffic to ease congestions, better safety for the locals for peace of mind. And fourthly, with regeneration, it will bring new employment because offices and commercial centers are established. It brings in more businesses and keeps the money flowing into the locality. This in turn will create a new desire for renters and owner-occupiers to move into the place. It lifts the demand for the place for people to stay in the area. And as basic as economics grows, more demand equals to uplift in prices. I'm sure all of you have been hearing a lot of the word regeneration when talking about London property investment. And because London is a very big and historical city, its history dates back to the Roman times, where you can even find the old roads where they used to ride horses, driven carriages to haul goods and people around. So naturally, a lot of these areas have not undergone the master planning needed for the modern age, or that it has outlived its use as the time goes on. Therefore, a lot of regeneration programs are going on in London. And you have been in the UK investment scene, you might have heard of regeneration schemes such as Woodbury Down, Stratford, Royal Arsenal, Elephant and Castle, and all these regeneration programs. This is actually really great for the city as it breathes in new lease of life into an otherwise old, tired neighborhood, or it transforms an underused prime area into a vibrant mixed-use area. All these regeneration programs are actually great for investors such as yourselves because it holds positive uplifts in capital values and reinvigorates rental demand among new demographics. That means the values achieved usually outperforms the values achieved in the wider market. As you can see from this chart, the regeneration uplifts accounts from 18 to 47% from the total price growth as compared to just the local authority growth. Hence why you want to invest in areas with regeneration programs. Okay. Jasmine has presented Crossrail is the latest infrastructure project to come out of London, and its impact can actually be felt tremendously across all parts of the city. After close to £20 billion spent with over a decade work have been done, this diagram is a demonstration of the impact of Crossrail towards the property market. You can read it on slide, but some of the more notable ones is on property prices, because we are all property investors here. We have seen over 31% price growth in property near to Crossrail station since it was announced. Also get this, a reduction of commute times by 10% can increase house prices by 6%. And once in full operation, some areas are actually going to have their travel times to key location cut by half. Just imagine what it will do to the property prices. Okay. Although there are multiple locations undergoing regeneration, just to give you an example so you can see the effects it has in the local scale, this is an undergoing regeneration story in Newham called the Royal Docks. This scheme here will create 25,000 new homes with 60,000 new jobs over the next 2 decades. It is also one of the only London enterprise zone with tax breaks and incentives given by the government to attract businesses to operate in this location. Home prices and the location here may jump by 30% over the next 5 years through 2026. This outperforms London 25% estimated growth and the UK's 20.5% estimates. Please take note, this is not the final stages yet. Although the area has already enjoyed substantial public and private sector investment since it was established as an enterprise zone in 2013, it is likely to reach close to £8 billion investment by 2037 to 2038. Okay, now I'm going to make a comparison of these two cities. Understand there are a lot of nations in this seminar. You might have invested in the local market. This is by no way, shape, or form to shed a negative light on the local market. But as an investor, we just need to be objective. This comparison will give you the information you need to make a decision between the two. At the end of the day, property investments do take a lot of money, and this is your hard-earned money. It's just the responsible thing to do. Okay, first of all, in London, you have a secured rental. Your vacancy rate is less than 2%. That is practically fully rented out. You can expect a consistent growth and high occupancy. We have had many stories shared by our clients where since the day they invested, they never had a prolonged vacancy. It is always one after another. The 2% is essentially the downturn where you are just cleaning up your place, waiting for them to move out so the next tenant can move in. In KL, it's the other way around. The rental is a bit inconsistent. There is supply overhang, high vacancy, erratic rental growth with a low to medium occupancy rate. Even in places like LCC, rents can barely reach 4%. And that's if you're lucky to get a tenant. Okay, next. In London, the demand is more than the supply. Of course, you hear stories about London all the time. The brand is there. Even if you want to invest in other property market, why will you get the leading indicator first? In places like Mayfair, Knightsbridge, Chelsea, and Westminster, the other only leading property indicator would be in Manhattan, but that's like 30 hours away from here. Okay. I remember one time I was promoting a Westminster property. We only had the preview talk, and I was talking to my clients. Naturally, Malaysians like to take their time, which is fine. Though we had an indication of price, the prices haven't even reached my table yet. By the time it reaches, only a handful of units left. I went to my client, he needs more time. 2 weeks after that, sold out. That's the kind of demand you have in places like Westminster. But that's fine, we have other opportunities. But as the famous song goes, good things might come to those who wait, not for those who wait too late. Okay. In KL, as it currently stands, supply is more than the demand. We had so much overhang that the government had to review the price threshold for foreigners. I have seen property that is still on sale for many years, asking for massive discounts, and yet still couldn't find a buyer because the product mix is just not there. Okay. And after that, London is a global city that manages to attract Fortune 500 global companies. If you're worried about Brexit, Apple, Facebook, Amazon all announced they are coming into London after the referendum. And as Jasmine was saying, Google just bought another building for £1 billion. That's not a small sum of money for its 10,000 employees, where these people are going to stay and work there for years to come. And in KL, unfortunately, there is a limited global appeal, with many companies are moving to other developing nations. We are losing out to places like Indonesia, Vietnam, Thailand. Hopefully, when things stabilizes, the sentiment changes because this is home. But for now, this is just the assessment. And moving on, as for talent pools, there's more talent pool with high earning population that is able to afford the asking rents in London. I think if I pick any one of the audience here, we have either studied, worked, or have a family member who studied and worked in London, you see? Whereas in KL, the city is suffering from brain drain and losing its human resources to other advanced economies. We don't have to go very far. How many Malaysians are working in our neighbor country? But not to worry. Many investors are quite worried, especially when our current political situation hasn't been sorted out. But I think it is safe to say, regardless of our political leaning, and as investors, we just want stability in the market. Moving on. Okay, in London, there's a renter's mindset, whereas in KL, many are actually purchasing for their own stay. Hence why we as Malaysians like huge units. You see, some of the most common objection that I get when dealing with high net worth clients buying for the first time in London. For example, I sell a 1,000 square feet, 3 bedrooms. Huh? 1,000 square feet only too small. I have to keep reminding them it's okay. Most of it would be corporate tenants staying with family. It's more than sufficient. They won't like it if it's too big, hard to maintain. Okay, and in London, in terms of number of transactions, there's a high volume of transaction annually, whereas in KL, it's slower and much harder to offload your portfolio. The thing is, there will always be a market for the London property investment. All the high net worth investors from every country and every continent loves to invest in London. In the 80s, it was Japanese. In the 90s, it was the African during the Nigerian oil boom. 2000s, it was the Chinese. Even us Malaysians went crazy in the 2010s, including many of the Middle Easterners. Latest is from Hong Kong. Who knows who is it going to be next? But you want to be there early. Okay. And in London, there's a higher population growth due to migration, whereas in KL, the number is declining and aging, which limits the number of potential tenants. I remember back when people were worried about overpopulation. In today's day and age, more economists are actually worried about underpopulation. It's difficult to sustain growth if there is no one to manage it. This is also why in places like China, they reverse its one-child policy, and many nations are actually encouraging its population to have kids with tax breaks and cash incentives to combat this problem. And moving on, for London, there is virtually no foreign ownership restrictions. They have competitive tax schemes. You can buy and sell to whoever and whenever you want. Willing buyer, willing seller, open market. When you buy, it's in the hands of Malaysians. When you lease, might be a Google employee from America. When you sell it, it might be an investor from Hong Kong. It's a global marketplace, truly. In KL, there is a foreign ownership restrictions. You have a minimum purchase price of 1 million ringgit and can only be strata. So there is the limit there. And overall, for the medium to long term in London, the outlook is more positive. You know where the market is going to be in a 5 to 10 years time from now. The universities are not going anywhere. The MNCs are relatively new to the scene. Fintech is on the rise, and Europe already has its winner. While in KL, it's unfortunately more cloudy. Yes, this is home, but that doesn't mean you can't invest in London, make more money, bring the proceeds back. It's investment-wise, it makes more sense, isn't it? Okay. And just as a summary, so what would investing in London bring you as an investor? At the end of the day, it comes to dollar and cents. And from previously mentioned, you can see that London has a high property growth. Let's look at the following chart. Overall, from this chart, England performance have shown a consistent increase in the price since the 1980s. And there are even data to suggest that it had kept uptrending even from the late 40s, post-World War II. Like any market, there are highs and lows, but whilst there are dips in the market, which you can see clearly from the chart, such as during the late 70s when the UK is dubbed the sick man of Europe, the dot-com boom and bust of the 90s, global financial crisis of 2007, 2008, you can see the market has always rebounded to be stronger. And London property prices especially have far surpassed the performance for the whole of England. This is also why we have advised our clients to treat their London property portfolio as a medium to long-term investment assets, because time in the market beats timing the market. Okay, now, as for this chart, back in 2020, a lot of people were worried because of the pandemic, understandably, that property prices might be negatively affected due to dwindling demand as people will be hunkered down in their homes and only buy bad necessities. And we had clients who held back their decisions because of sentiment, like those preppers. But as this idea actually goes across all industries, including automobile, computers, gadgets, even clothing. However, economists and analysts were seriously wrong about the evaluation. The only thing that held back the demand was government's policy. But as soon as it's lifted, it's like the floodgates were open. People are buying in droves. Cars are flying off the shelf. There's not enough chips to go around. People are fighting over PS5 and watches. Shelves are being restocked as fast as the shipments can reach them. So we hope that we don't get another evergreen incident because it will be pandemonium. But how does this reflect in the UK property prices? If you look at the data, you can see that overall, price has shown a healthy growth. Many of the areas are able to achieve double-digit growth as people are looking for houses with larger spaces and outdoor areas. Even when there are a lot of skeptics that are saying that London will lose its appeal, from the data, it's simply just not true. Price in London has increased at 5.5%, and this is up until December. Actually, the number of inquiries for London have shot up as time goes on. Okay, and secondly, as a summary, you will secure a rental income when you invest in the UK and London property. In addition to the high property price growth in the UK, as investors, we are of course always concerned, will there be enough renters? Will there be growth in the rental market as well? Which you can see in the recent data, rental growth has showed a strong 8.3% growth in 2021. London property rental showed even higher growth at 10.3%. On an average, it takes only about 2 weeks to let out your investment property. Some you have even to be in the waiting list. And average monthly rent is about £969 per month. And what usually comes after rental growth? That's right, house prices. Okay, next point. There's also a continuous rental growth due to shortage of supply. As Jasmine has elaborated, due to the land prices keep getting higher and higher, supply chain disruptions, red tapes from the government bodies, and continuous demands from the population growth, there will be continuous rental growth in the foreseeable future. This is reflected in the 5-year projection rental growth that is close to 19%, with prime community zone estimated to grow at 13%. And moving on. In addition, in investments, you will want to use leverage in order to increase your investment by multiple folds. And London property allows you to just do that. A very important aspect for property investment is financing. Many banks and financial institutions are very comfortable in lending to a secure market such as London. I have clients who have been approaching me into other property markets as well, places like Bolivia or other parts of Eastern Europe. And look at what's happening now. Not to say I told you so, but I told you so, you see. But the availability of financing to international investors for London properties is a critical factor for its continuous growth and demand. Even in Malaysia, we have several banks which lends to London properties, offering loan currency choice, either in ringgit or pounds. Also, if you buy property through UK company, financing is also available up to 75% LTV, all of which makes investing in London properties much more accessible. And finally, just to hammer down what Jasmine has presented, you will want liquidity when investing in property. Where can you find the real estate market with high liquidity? London. At the end of the day, you will want to be able to exit your investments just as quickly as you were to enter it. The number of transactions for residential property that happens in London would allow you to just do that. Property is already an illiquid asset. By being in the highest volume real estate market in the world, you would have a much clearer exit plan. There is less volatility, and you would be able to safely predict and plan for your future. Okay, so back to the question. What would investing in London brings you? With all of these factors come into place, you would be able to unlock your goal, whether you can utilize your London investment as a retirement funds, go on your holiday, buy your dream car, or for your kids to go for education as part of your legacy planning for the next generation. We would want our investors to achieve their dreams. And what better way to help you to get to your destination other than investing in a safe, dependable, and reliable asset like a London property? Isn't that amazing? Now, moving on to the next section, I shall hand it over to Shelvin.
Thank you, Nazim and Jasmine. Finally, I have waited for 50 minutes to come to my turn. I hope you are still here with us, because what I'm going to share with you is what is missing as of now, because we have got all the all the helpful tips and the fundamental knowledge to understand how to buy well in the UK market. And then what is missing now is the right product. So all that, ladies and gentlemen, tonight is the night that you will get the first-hand investor insights for this beautiful scheme called the Royal Eden Docs. Okay, Royal Eden Docs, it was actually also briefly mentioned earlier under Regen topic. And for us, it's actually a development that tick all the boxes, all the essentials that would offer a solid ground and factors to achieve both rental and also capital stability. It's a high volume market. We cover this in our helpful tips as well, the fundamentals. It's also a market with many properties being traded. There were basically 150 units transacted just in year 2021. And overall, the sold prices in Royal Docks, the area itself, over the last year were 44% up on the previous year. And secondly, it's set within a Regen program, the Royal Docks, which will be London's only enterprise zone with tax breaks and also business incentive, especially being offered to startups, including people coming from the creative industry, people coming from fintech, and from there they are going to create 25,000 new homes, because you have 60,000 forthcoming new jobs within the next 20 years. Thirdly, infrastructure spending. So we've got Crossrail. We got 500 million London City Airport expansion plan and £1 billion Silvertown Tunnel. I'll explain that into details later on in a slide later. But there also will be a plan for an Institute of Technology that will focus on transport and also infrastructures engineering in near future at the same area. Fourth, you have got ready tenants. You're surrounded by executive level tenants who work in Canary Wharf, the financial district, then also the city, Stratford. In fact, the current asking rent now is even higher than what was being forecasted last year. Last but not least, you will be backed by a reputable developer who has 30 years of experience with solid track record. And they are also multi-award holders in the building industry. Let's take a look at the development, a quick summary of Royal Eden Docks. We are basically releasing two blocks, one called the Wellspring and the other one is called the Ellipse. There's no difference because both offers a very good time frame for capital appreciation, as the completion will be 2 to 3 years down the road from now, which usually sits well for Malaysian investors who want time to make money for them. Okay, let's go into details. From the macro view, as we mentioned earlier, this is actually a waterside address in London. If you're familiar with London, you can easily identify a few landmarks from these area pictures, such as the O2 right here. It was briefly destroyed because of the, some storms, unit storms, but they are putting in back all the roof now. You can also see Canary Wharf from here and the city. Just to share with you, London Mayor Sadiq Khan, and he's one of my idol, by the way, and his London Assembly have finally moved into the Crystal Building right here on the 21st of March, just recently. So all the formal meetings of the London Assembly will take place at this new City Hall from now onwards. The building itself and the cafe are also open to the public. So Sadikan says the move to the new City Hall will actually act as a catalyst for the regeneration of royal docks. Something for you to take note because he himself endorsed a regen scheme. This is a map, which is a map that shows all the price per square foot comparison, which will also perfectly showcases how affordable Royal Eden Dock is. So you will see this is 6% higher, one stop away. We've got Greenwich 18% higher than the price per square foot in Royal Docks. Canary Wharf 45%. And then we got Shoreditch, also one of the most talked about areas for London, even for Malaysian investors, 50% higher. Last but not least, the city, 99% higher. Oh my goodness. But in general, Royal Eden Dock is 35% below London average price. And personally, I think it set itself a much better proposition being a waterfront development with price per square foot below 1,000 a foot. Given the fact that anything that's near River Thames nowadays are all asking above £1,000 per square foot, easily. I would also like to emphasize that whatever Royal Eden Dock is undergoing now is exactly what Canary Wharf was experiencing the past decade. As we are the market pioneers since 2009, we are also the perfect candidates who can testify how regen brings about changes to an old area. So back in the days when we market in 2009, 2010, when the market was still recovering from GFC, the global financial crisis, the average price, ladies and gentlemen, the average price in Canary Wharf was below 400,000. Yes, unbelievable, but that was the price back then. And we actually sold like hotcakes. So Canary Wharf, nowadays, if you're talking about the price of a two-bed, back then, okay, 400,000, can't even get you a one-bed now in Canary Wharf. Studio, maybe, but you might be looking at less than 400 square feet internal space just to justify the current price per square foot. So the 10 years capital growth in Canary Wharf was actually 110% through the factors coming from high volume market, regen effort, infrastructure spending, such as the Crossrail, the Dockland Light Rail. There is also some new commercial zones and offices called the Wood Wharf. There are also new housing, high-end condo, which enable Canary Wharf to overturn its address being the dodgy Dockland area to a world-class integrated neighborhood surrounded by all high-income earners who actually has the average household income of nearly £56,000 per annum, which is actually 86% higher than London average. So that is the power of regen. This is also where you can maximize your return if you know when to buy low and when to sell high. Okay, this is an exciting slide because I'm comparing the price per square foot between new builds in Canary Wharf and also Royal Eden Docks. So the developments that we have picked to be in our comparison studies, such as South Quay Plaza, Landmark Pinnacle. I don't mind naming all of this because we all have access to the project. We also have access to One Park Drive, Wardian, Vetro. They offer similar range of amenities, size, and also lifestyle. So as you can see, there is actually an average of 70%. I just balanced out 70% price gap, which further attests Royal Eden Docks as 35% more affordable than London average housing. So bear in mind that these are the prices that we got from all the new builds, not the secondary market, but new builds. So it's comparing apple to apple. Back to this slide, this is basically more information regarding the regen scheme in Royal Docks. It has 6 segments. So we've got Silvertown Quays, commercial space, we have Royal Docks, then we have Albert Island. This is where all the new Institute of Technology will be located because it's actually very close to University of East London. Down here, we have London City Airport, which is already there. But because of the influx of new business, they also want to attract more businesses as well. They are expanding it to add more platforms, to add more airlines. So in the end, they will be in total 500 million investment fund in this particular program itself. Crossrail, of course, we know Crossrail, by the way, is 15 billion region scheme, region program for rail track, for railway network. And that will be a new Crossrail station, 3 minutes walk from Royal Eden Dock. And ladies and gentlemen, you don't need to wait because it's coming soon. It is actually in test run now. The former operation of Custom House Crossrail station will be up and running in 2 months' time. So you don't have to wait. And also, the last but not least, the Silvertown Tunnel. As you can see, we only know there is an Emirate, cable line here, but they're actually building a tunnel underneath the river. We will also provide fantastic connection from the south of the river to the north of the river. So that means business opportunities and job creations. Okay, here comes another close comparison. Royal Wharf, which was the region scheme that we had the honor to market a couple of years back. It's another big placemaking with 3,400 new homes. So the earlier phases were the apartment closer to the river. I can actually point out from here, we were launching the apartments around this part of land, but they are basically slightly further away from public transport. So this place used to be an industrial land. And when it comes to industrial land, you have warehouses, you have old gas holders, you have ugly storage houses, workshops, but these all have been gone, long gone, with the power of regen. So investors were able to achieve a decent capital appreciation despite challenges coming from, Brexit, all this referendum talk, all the speculations. Then suddenly we got hit by pandemic, COVID-19, which then also take us to the next slide, because you will know what will be the transaction like. This is a list of transactions that took place in Royal Wharf just in 2021 itself. This is just the tip of an iceberg, but it's also an example of a high volume market. So on an average basis, the units were able to achieve between 11 to 12% capital appreciation in 4 years. Some could achieve higher, some could achieve lower, but in general, it's more than 10% in 4 years' time. But also do bear in mind that 2020 and the first quarter of 2021 were the years when the pandemic put a pause onto the property market. Yet, the market quickly rebounded and in fact, outperformed pre-COVID times. So the moral of the story from the slide is a high volume market is a resilient market, and it also a market that provides exit strategy. Remember what we covered earlier on, infrastructure spending, the Crossrail, Elizabeth Line is just 3 minutes walk from Royal Eden Docks. So from the station, it takes only 3 minutes, another 3 minutes to get to Canary Wharf and 10 minutes to the city. So in 10 minutes time, in a nutshell, you get to travel to 2 financial districts. So when the Crossrail station is ready and to be put into official operation in April, May this year, the asking price and the asking rent for the properties located within 10 minutes walk from Custom House Station, for example, will be expected to enjoy at least 10 to 15% uplift immediately. I do have a client which I just had a chat just recently, 2-3 days ago, and he basically has almost all the properties closer to Crossrail Station. He's really the champion investor and he's my long-time investor. Unfortunately, he can't make it to that webinar today, but I'm going to share his example. He has a unit near a Crossrail Station. He bought it in 2015 and the unit was completed in 2018. And now that the Crossrail is already completed and will be put into a formal operation, he called up the tenant and say, hey, do you know that Crossrail will be up and running soon? And I would like to revise my rental. And the tenant say, Okay, no problem. What is the increment you're looking at? He say 10%. And the tenant say, done deal because I want Crossrail. As simple as that. So it's actually an immediate uplift once we know that Crossrail will be up and running soon. So going back to the basic, when there is infrastructure spending, there will be human traffic, and that will be job creations. Hence, there is demand for new housing. This is an evergreen formula. Tenant pool. So this map itself, we will see Royal Eden Dock is on this right corner. We are in zone 3, but we are like to focusing on the tenant pools from the slide. So from here, you get to travel to Canary Wharf, you get to travel to Liverpool Street, you can also travel to the bank via DRR. So these are basically where your tenants are coming from. Just to share also the current rental market in Royal Docks area. These are the asking rental on semi and fully furnished basis. So according to our work partners, the letting partners in London, units will be taken in just a matter of days or maximum 3 weeks maximum due to the return office crowd in London. The next slide will be the rental comparison between the current market rate and the estimated rate for Royal Eden Dock. But just remember, this is the typical 1 bed asking rent. We are looking at about 1,008 in general, 1,007, 1,008 per month. That on the right side is the 2 bedroom, 2 bathroom, and you'll be seeing around 2,002, 2,003 as the monthly rental. So keep this figure into your mind. Let's do the comparison on the next slide. Yeah? Open your eyes big. So these figures shown in tables are the estimate given by Foxtons. So they are basically one of the most active letting agency on the ground. And you will know that this is self-explanatory. There's no big gap between the estimated rental value and the current asking value. You see studio current is 1,006, but the estimated rental yield, rental rate that we forecast for 2,000, maybe in 3 years time will be 1,625. This is very underestimated, I would say, very underestimated. You will understand that why, because there is a return office crowd back to the market. And do also take note that these figures are quoted without factoring in the Crossrail. As I mentioned earlier, there will be an uplift in rental value as soon as Crossrail is in formal operation. Now, here comes the most important slide of the session, because everybody is asking, hey, I want some cash flow calculation. I want to see how I make money, how I give out my money, how I place out my deposit, how I get it back. Of course, we are going to do illustration. So take this 1 bed as the example, as our case study. And before I jump to that, I would also like to let you all know in RBC, we take pride in being transparent to our clients. So there's no such thing called hidden costs, because we are 100% upfront with all the fees incurred. So there will be fees incurred during acquisition stage and also holding stage. So as I mentioned earlier on, we pick 1 bed on the first floor as a case study. We have also factored in the discount. Of course, Malaysians love discount. So we have a 5% discount. But of course, in a nutshell, you will see that you will have 4 stage payments when it comes to deposit. But in total, it's 20% deposit. And though this 4 stages statement is actually a breather for most of our clients, our investors, because they are not required to come out with 20% straight away. We have also thoughtfully put in the column for Malaysian ringgit just for your reference. So you know how much you need to come out for your Malaysian ringgit account. Now, most importantly, the 20% will be all coming out in the span of 18 months, but the balance 80% will be upon the completion. Either you are looking at 2024 for the Wellspring block or 2025 if you're taking the ellipse. Now, here comes the details of the cost. One-time cost, we have legal fees. Of course, you need a legal practitioner to handle your S&P, will be a UK lawyer. You have stamp duty. We're also factoring in the non-UK resident tax, which is at additional 2%, because most of us are Malaysian. We are non-UK residents. But in essence, the stamp duty for anything that is between 400,000 to 500,000 will be all at about close to 8% effective rate when it comes to stamp duty. Now, that is your total acquisition cost. You don't have to pay for stamp duty now, you will pay upon the completion of the property. Annual expenses is where when you complete the property, you start paying for the service charge. So this is the maintenance cost, the management cost for the building. Then you have ground rent, which is equivalent to our quick rent in Malaysia. And it's only £400 per annum. Yeah, this is not per month, it's per annum. Letting fee is when the agents will manage your property. They find a tenant for you, they collect the payment for you, and they manage the property for you. So yes, they do collect a fee at 12% plus VAT. Council tax, you don't have to pay if your unit is being rented out. It's only when you stay in the unit yourself that you have to pay. But if you know what council tax is, if you don't know what council tax is, this is basically like our assessment fee, yeah, in Malaysian term. So all in, you are paying about 6,000 as your annual holding cost. But remember, you do draw an income when you rent it out. So assuming you are getting 1,850 per month, the annual rental is 22,200. We take this cost in, we minus off, the net is 15,000. And from there, you are still achieving 4% on the net basis, which is very rare, ladies and gentlemen. Usually when you take the cost in, you minus everything, it will be around 3% in general when it comes to London property. But in Roy in the Docks, you can achieve 1% extra because of the strong rental income. This is a cash flow, which I also factoring in the mortgage. So assuming you're getting a UK mortgage on the interest-only loan basis. So I factor in 70% loan. You're paying just the interest at 3%. And then all these red color here, they're basically representing costs, the money that will go up, okay? This is money that is going in. You minus off the service charge, which I covered earlier on, the ground rent, the letting, and also the mortgage interest. You don't have to pay for principal. You are still achieving a net income per month at £593. And that equates to, in a year, Malaysian ringgit, hello, everybody, open eyes, big, big, is 40,000 ringgit per annum. You tell me, where can you find this for a Malaysian property? I don't think so lah, at this current market situation. Okay, now return of investment projection. This is more on the capital appreciation side. So assuming we are getting 4% capital appreciation per annum from the original asking price, that means before discount, then you buy it in 2022, which is this year. So we are doing a valuation 5 years later, and the value come back under a very conservative calculation. It comes back at 533,000. Now, remember, we do make a surplus on a yearly basis. So I actually factoring in 2 years cash flow surplus right here. Then I also add on the capital appreciation equivalent to this amount. So total profit on paper, you're having 130,000 minus of your acquisition costs, which means the lawyer fee just now we cover all the lawyer fees and the stamp duty. Then the net profit comes out as 93, close to 94,000. That is 520,000. Again, going back to Malaysian context, in 5 years' time, if you can get this kind of profit and revenue, you're considered super lucky if you can have it in Malaysia. But in London, it is very realistic and it's also very achievable if you buy into a regen scheme. So in a nutshell, the returns on investment on the net basis is 22%, which is fantastic. And it is also a healthy growth. It is not a superficial or rocket science. Tax. This question, tax question, I get every day one. I have to really cover today. I must cover today, even though I overtime, but I have to cover today. Yes, when your unit is actually deriving income for you, Yes, you have to pay tax. I'm sorry, you cannot run away. Do not do tax evasion because the crime is very big. Don't evade your tax. You have to do filing. So basic tax rate is 20% if you have a net taxable income below 37,700, and then 40% between 37 to 150,000. But of course, the 40 and 45% is really based, is really more affecting to individuals who have multi-million properties lah. But if you're on the very first time startup, on your very first time looking into London property, I don't think you will be exposed to 40 or 45%. And the good news also, yes, we have personal allowance, even though we are not UK residents, but we are Commonwealth country. So we get to enjoy 12,570 pounds as your personal allowance per annum per person, which means your income, okay, imagine you have 30,000 income. The first 12,570 is tax-free, as simple as that. And apart from that, by the way, Singaporean don't have, we have. You also have tax deductible items. No offense to Singaporeans, sorry, but yeah, Malaysian have. You also can deduct service charge. You also can deduct your ground rent, your letting and management fee. And if you have a landlord insurance, yes, it can be deductible as well. So let me show you a quick and simple illustration. And because I'm basing the scenario based on the most common holding structure in Malaysia, joint names. So you will see, you actually will save a lot of money if you have a joint name structures as the ownership. So your annual rental is 22,200. Okay, based on the 1,850 pound per month rental, because we are using back the same case study, the 1 bedroom. Then you minus off service charge, ground rent, that thing. Net income is 15. Okay, if you focus on this column, right, this is more like a joint, more like a sole ownership, like you are just one owner by itself. So you are still paying 20% tax rate because your net income is 3,000 and 658 is a small amount. But ladies and gentlemen, if you have one more purchaser, you actually don't need to pay. It's not magic, but we are able to use all the cost and income into half. And then you are still enjoying full personal allowance per person. So in the end, it's actually minus 4,000. You don't need to pay, but please file in. You have to file in. Okay, you have to file in. So please, if you consider to be more tax efficient, a joint tenancy or joint ownership will be the best way for you to achieve that. Last but not least, developer. So you have to know your investor partner. You have to know who built the scheme for you. So a developer who can deliver at or above expectation is also able to determine your success rate of the property, of the investment. So Mount Enfield themselves is a London-based developer. They are established in 1991, and they are now a leading player in the central London residential property market. They are also multi-award winner in the building industry. So allow me to highlight this. Roy Eden Dock was actually the finalist for London Planning Award because of the design directions and also the sustainability program, which is now a very important factor as far as climate change is concerned. So in Mount Enfield, they have a very distinctive business model because 90% of their staff are actually shareholders. So their hard work will also determine their dividend payout. These are the projects, their portfolio. This is the past portfolio, and this is the current projects they are selling at the moment, which we also have access to. So the specialty of Mount Enfield is they are able to always select the right locations. It is usually very close to cross-tube station or tube stations. And then they are also able to bring, they are also very design driven, and they do really care about customer service. So I do have clients who come back to me and say, hey, I'm very happy about Mount Enfield because they actually update me in a very personable manner. They would WhatsApp them, they send them videos of their own units. They put in personalized messages as well. So these are all adding points to your investment success, because eventually when you want to sell your property, you can always find a buyer, because the buyer will also look at all these kind of aspect and unique selling points. And also, I would like to highlight that this Royal Eden Docks is not just by Mount Anville. They actually join forces with Excel London. So Excel London is not just an exhibition provider in the Royal Docks area. They are basically one of the biggest employment hub. They contribute to the economy at about 4.5 billion pound in the local economy, and they support close to 40,000 jobs. So because they know the potential of Royal Docks, they know how much of business potential they can bring into Excel London and bring into London Docks, bring into Royal Docks area. So they join forces with Mount Anville, being the pioneer in building industry. They will know how to come up with the finest product in this location. Next is us being in London. I can't wait to travel to London, but basically I want to highlight, apart from looking good in the pictures, behind all of these landmarks, we RBC team actually do travel to London and we make progress report for our clients. So we will personally go into the developments that you have already invested. We take pictures, we take videos, and we'll send to you. This is part of our service. As you can see, we have already aged, but we are still young at heart. Basically, that's the moral of the story. Coming out is a few quick ones with the projects, the developments that we have already launched in Malaysia in terms of physical events. So we have got Kidbrook Village, we have the Seal District by Mount Anville also. We also have Green Quarter, Woodbury Down. All these are region scheme, by the way. Very well perceived. Then we've got Prince of Wales near Battersea, Malaysian favorite. Then we also have Western Circles in Acton. Okay, ladies and gentlemen, finally we have come to the final section of our webinar, group buy opportunities. And that takes us to the next slide. Let me explain what is group buy. So we are very excited to announce that we are launching RBC Investor Community officially tonight. And we want you to be part of us. So we have done this in the past. We know how much group buy would help a lot of investors to make even more money. So when you subscribe to our RBC Investor Community, we will share with you firsthand whenever there's a group buy opportunity available. So what does that mean to you? It means you join forces with like-minded people to get bigger discount for property that we think that has very good potentials and opportunities. So you get a head start. You can get a better rental yield. You can get more savings in the pocket. So basically, when you buy at the lower entry price, just imagine you're buying a stock. Okay, we put things in the stock context. The stock is currently at $100, but you manage to get it at $90. Wow, you have saving of $10, right? So you already have a head start than anybody else. So similarly in property, if the property is priced at £400,000, but you manage to lock it in at £380,000, you already have a great head start. So that also means that you make more money from this investment on top of rental yield, your capital appreciation. And we are all very research driven. We do our own due diligence, and we will not just simply select a project and throw to you and say, hey, buy, just to get discount and then deliver to you. That is not purposeful, and that is not our end goal. Our end goal is buying the right product with the best potential, but at a much bigger discount. So if you're interested, commercial time, DM us with your mobile and email address. Okay, DM means direct message. You can drop your message and send to us in this group chat, in this chat room. We will, or even you can go back to the RBC advisors who invited you to join this webinar. We will get in touch with you and we will discuss this further with you straight away. And I want to emphasize that the purpose of this group buy is the more, the merrier. We will make out of this. Okay, so Another commercial time, Royal Eden Docks will be having an exhibition, exclusive event at Four Seasons Hotel, Kuala Lumpur, on the 9 and 10 April weekend. Not this coming weekend, next weekend. Okay, if you're interested, please come and see us. But if you're interested in a group buy opportunity, see us before the event, because that is where we'll pick up all the nicer unit for you. But we also be having a market seminar on both days at 2:30. So if you are coming for just to see the property or you just want to join the seminar, everything will be based on appointment, because we do have to still keep the COVID SOP in place. So let us know. We will put you into a personal slot. Then we will take it from there. Coming up finally is the FAQ. So everybody, if you have any questions, you can drop your question in the Q&A button. You can see the panel down here. Just click on the Q&A and type your question. We will get to it. But I think first thing first is to also address some questions that we received before the webinar. So I think a lot of clients also want to know what will be the Russian impact on London property prices. So Jasmine, would you like to take on these questions?
Okay, we're a bit overrun, I think, Miss Xiaowin Tan.
Yeah.
But anyway, I'll do my best to just give you a quick summary of what I think the impact of the Russian-Ukraine conflict has on the property prices in London. So we actually did a market update just last Saturday for our clients to address this. This was something that just happened on Saturday, but I'll summarize it here. In essence, the Russian buyers only represent a minority in the London or the UK market at this stage. They used to be a much bigger percentage, but now they're just a very small percentage of the market. If you look at that chart or that table that Xiaowin has just put up, Russia is only contributing 1,127 homes registered to a Russian-owned address itself. Okay, the higher number of properties that being registered to overseas people are actually from Hong Kong, Singapore, and even in Malaysia, you can see we actually didn't do badly as well. So Malaysians are pouring money into the UK with 10,177 properties purchased in 2021. Now, this severity of these sanctions is really the beginning of a new world. What does it really mean for you guys as investors? Is that because of this war brought about by the Russians, the UK government is actually under a lot of pressure to implement further transparency measures, which has already been happening in recent years. So I know that I can see that from some of the participants here, they're already UK London buyers. So and they have some of them been buying through us since quite a few properties and throughout the years, you will have already experienced that the anti-money laundering check has been tightened. Okay, and this will increasingly, if you can go to the next slide, it will actually increase that ownership disclosure. So most of us, we are fine, to be honest with you, unless you are a super rich or you're super politically, exposed and all that. Otherwise, for individual buyers, you actually don't need to be very worried. But when you do the settlement of your properties, okay, you will experience a bit more verification on where the sources of funds are coming from. But I don't think it really affects individual buyers or Malaysian buyers on buying that 300 to 1 million pounds property. They are really after those people who are hiding behind a web of very complicated shareholding company holdings as well. The other thing that will happen from here, from what we can see at this point in time, is that there will be opportunities. But that opportunity probably will rest more in that top-end market in prime central London. Because if more Russians are forced to sell their properties, right, then of course there will be some bargains, Russian bargains in the market. But that Russian bargains in the market will actually be quickly replaced by other billionaires from Asia, from India, from Brazil, and all of that. So we don't think, again, prices are going to be drastically impacted. And also that amount of stock that is also going to come onto that market in the prime central London is actually very limited. And at the moment, of course, there is a sense of a temporary pause in the marketplace itself, because it's not just the Russian-Ukraine news that they are digesting. They're also digesting the interest hike, okay, which at this point in time, it's just 0.75%. They will look to increase another 25 points by June this year, and then upwards to probably at the maximum, we predict to about 2% by next year. But this is still historically very low. If you look at the interest rate pre-GFC, we are talking about 4%, 5%, 6%. So at a 2% interest rate, you are still reasonably able to access to cheap money. But of course, I think overall, there are some concern in the market. There will be a segment who will be worried, okay, about the rising costs as well from all of this. But because the unemployment levels in the UK and in London in particular is very, very strong. So you see all these MNC are all coming in, as we've all explained already. They are offering very secure employment. So people are still able to have that employment to go out and buy their property. And international buyers, like from Hong Kong, for example, they are still going to invest in the UK because they are politically, they want to have another safe haven outside of Hong Kong. They're buying for a different reason. So always in London, you will find that you're not just looking at what's happening in the domestic market. You also have what is happening in other countries' market, such as, you know, in Brazil, in the Middle East, or in Hong Kong per se. So people buy into London as a safe haven. And all these buyers or people who are going to buy into London, the international part of it will always change, but there will always be that consistent volume of international buyers into London. So yes, early days, we are talking about very early days of what is the ultimate impact of Russia-Ukraine. And this temporary pause, I say confidently that this is temporary. It is definitely a window of opportunity because the market is pausing. We don't see prices going up. We will see prices plateau. But because the local demand is still very strong, we feel that this is a good time for you to get in. You may get, you know, just now Xiao was already saying that we have this group buy opportunity. Now is the time. Like GFC, people were all scared. You know, those people who have been through GFC, they will tell, they actually, some of them have missed the boat, okay? Because they were worried, they were thinking prices will drop. When will prices drop to the lowest? They want to wait until the prices drop to the lowest. But it did not happen. They wait and wait until the opportunity were gone, and then the prices keep going up. And they missed the boat. So my recommendation is, having been in the market for so many years, London is really very resilient and almost bulletproof itself. So if you do want to invest into London, I think it's not a bad time because the prices are quite flat now. But the local demand, buying and selling in London, is still very, very active. So don't underestimate. And if you're looking as a normal, probably investor from Malaysia or Singapore, they typically look at 350,000 all the way up to under 1 million pounds. That segment is very, very solid and very healthy. It's not going to be drastically affected by this Russian-Ukraine war. Yeah, so I think that's my reply to that. So the fundamentals of London are just very solid, and it's unlikely because the supply-demand imbalance, right? It's just too much demand, too little supply, and prices will just keep going.
Thank you, Jasmine. We do have another questions which is related to stamp duty. This client is asking what makes UK a more attractive options when it comes to stamp duty because I think they are also comparing with other countries as well. So Nazim, you're expert in stamp duty. Would you like to take these questions?
Sure. Can show the slide.
Yeah.
Okay, for this one, This is actually a table of popular investment cities, which shows the various SDLT treatments and ownership restrictions for foreigners. As you can see here, out of all the global cities, even with the recent 2% SDLT that is applicable to foreign investors in the UK, in the long run, it still makes sense to invest in London. If you look at capital growth, it just means that you have to hold your property 6 months more than the local investors to get back your costs. And if you join our group buy opportunity, you make your money already. So no need to worry about SDLT. It's just part of the ownership cost. We will help you to find the correct product or with the right investment or with the right incentives to make your money. So no need to worry about that.
Yeah, we do see a huge difference between UK and my God, Singapore 30%,
Yes.
Hong Kong 30%.
Yes, as you can see from the table here, even compared to other countries, we are only 8%. Singapore, Hong Kong already 30%.
Yeah,
Australia 10%. You know,
exactly.
and Malaysia 4%. Although Malaysia is 4%, so you have like we were mentioning before in the comparison. So there are some limitations in what you can get and the prices and all that. So you just have to be careful. And I think I also see a question regarding the flight path. Okay, just to answer these questions real quickly. So this question I think has to do with I think the questioner is worried about the noise. So in terms of operating hours, for London City Airport, you cannot operate midnight until dawn for the weekdays. And on Saturdays, it's actually, you cannot operate from afternoon until dawn. On Sundays, it's from midnight until mid-afternoon. So they are taking into consideration all this for the well-being of its residents. And you don't have any operations in Christmas. And you only have some type of aircraft that can operate here. You cannot have a single engine aircraft, which is very loud, and you cannot have helicopters and VTOL aircraft. So these are the type of aircraft that is restricted for this airport. So they are really seriously considering even the type of aircraft and the number of aircraft that can fly into this airport over the years. So I think this has to do mostly with noise issue for the residents.
Yeah, definitely. Okay. Thank you for answering that, Nazim.
No worries.
Any more questions from the floor? Okay. Okay, we actually got a question prior to the webinar as well, and they were asking how we function as an advisor to help our clients to buy their property in the UK. I think first thing first, we do have a set of guidelines that we usually would tell the clients. You would have to know, you have to understand what is in your thought process in terms of your investments, budgets, your strategy. You have the short-term and long-term goals and all that. So we actually will sit you down and go through all of this. And then from there, we will clean and we will just give you a bit of a clearance on your thought process. And from there, we'll narrow down to a few options. So once the match is found, we will guide you through all the reservation process. So reservation process is actually very, very straightforward. Once you find a property, we will make an offer to the developer. So once the offer is accepted, then we'll move on straight away to reservation. Then usually there will be a reservation fee collected. So reservation fee is actually an earnest deposit for you or for the developer to take the unit off the market. So it will be safely secured for you. Then we're going to move on to the next stage. So next stage is we will move on to talking to or recommending a solicitor who will be handling your S&P. So from there, we will actually set up a few Zoom calls, at least 2 Zoom calls between you and the lawyers, First Zoom call will be more on knowing who you are, knowing the customer, and then they will come out with a few questionnaires for you to fill out to understand your source of fund, your proof of fund. So that these are all very simple standard AML procedures. Then after that, the second meeting will be more on after they got, they have got all the contract papers from the solicitor, from the vendor side. Then they will go through the clauses with you. So they'll highlight all the points and the clauses that you should be aware as an investor or as a buyer in the UK. So prelim legal meeting set up, especially for first-time buyers, because you have to know your legal rights in the UK as a first-home buyer. Then we'll also promptly remind and assist you on mortgage application. So basically, there are two scenarios. If you are going through a local Malaysian financier, then you can perhaps lock in your mortgage offer for 36 months. Meaning to say you can already start your application 3 or 2 years before the completion of the property. Okay, but when it comes to UK financing, meaning to say you're actually applying through a UK bank, then you could only start your application 6 months before the completion. So that is actually our role to remind you, to send you a message or give you a call, Mr. So-and-so, it's time for you to shop for financiers. Then, of course, we will come up with a list of recommended financier or mortgage broker for you to choose from. We will link you up with them. We'll sit in the meeting with you to understand your financing needs. Then after that, completion process is when the property is due for completion, is in the legal handover stage. And even prior to that, we will also prompt you, hey, Mr. or Dato, your property is in completion already. So I want to make sure you have all the money ready. It's time for you to settle the balance. So you must make sure the mortgage is already secured. Or if you are a cash buyer, you must also make sure that your funds are all ready to go out to settle the balance payment. Then we will guide you through how to complete the completion process. Basically, you don't have to fly there. Because a lot of people will ask, hey, do I need to go there and collect keys? I don't need. If you're there, then of course, take it as a holiday. But if you can't, we have all our working partner, letting partner, who can also do the snagging for you. But when it comes to legal completion, all you need to do is to sign the lease document, sign all the relevant completion papers, send it back to your lawyers, then 搞定. This is when you complete your completion. Then from then, the next stage is to find the letting partners for you. We'll find the tenants, we'll find the right leasing and property management people to lease out your property. And of course, when it comes to this process, it's going to be a very professional process because they don't simply just, pick a tenant for you. They will have to go through rounds of scanning, rounds of AML compliances. They have to know the tenants, whether they have the money to pay your rental. So they will also even ask for proof of employment or even proof of fund from the tenant. So once this is all set, then once you agree with all the rental offer, then your unit will be all set to go, will be all rented out. And then from there, all you need to do is to sit down and receive your rental income. So it doesn't stop there. Once the completion is done, it doesn't stop there because we will still deal with you, we will still speak to you, we'll pick up your call. Even though you have any other concerns or issues you may have, we are always ready to pick up your call and help you. We will also advise and assist in the resale of your property. So say, for example, you hold the property for 5 years and you want to just let it go, you want to sell it. And even when the time is right, the market is good, we will also come to you and say, hey, you know what? This area is very hot now. I think you can sell now. Then this is when we will jump in and help you to find the right buyer for you. So all in all, RBC is a one-stop hub. We are not just an agent. We are advisors. We are your friends. We are your investing partners. And that takes me to the next page. Ta-da! That's us. Sorry, Jasmine is not in the picture. She's in Australia, but spiritually, she's with us.
You haven't died yet, but
we will see you soon. We'll see you soon. Maybe in London, not in Australia, but yeah, Australia a bit boring. We go to London and then we will have a reunion there. So I think that's probably about it. We had to wrap up now. We are super overrun. So
Thank you all
Thank you very much. Yeah.
for spending the evening with us. I know a lot of you sacrifice your Netflix time and your chill time to sit through this with us. I hope you guys have really found it informative and useful. So just let us know. Some of you don't want to put your question through in the chat. That's all right. Just come to us and just give us a buzz if you need to ask us any further questions or any details on any projects. Thank you so much for joining us, and we look forward to hosting the next one again.
Thank you so much, and
Thank you so
enjoy
much,
the rest of
everyone.
the evening.
Thank you.
Bye bye.
Bye bye. 안녕하세요.
안녕하세요 is konbanwa.
Konbanwa.
I just started watching Korean movies.
Okay,
No
now
wonder.
I have to pick up the language.
okay. I will end this webinar and then we will touch these separately. Bye bye.
Bye. Bye. Thank you, everyone. Have a good night.
Have a good night.